Welcome to 20-Minute Leaders. Just sit back, relax, and learn from the leaders of today. It's a journey. Each one is different, unique, inspiring. Let's get started. This episode is powered by J Ventures, a community-driven VC fund in Silicon Valley, in partnership with LeumiTech, sponsored by Homeward Ventures, Hippo Insurance, Upwest Labs, Synergy Global, Hillel at Stanford, Leap, Birthright Excel, Serona Partners, and in media partnership with C-Tech. Welcome to 20-Minute Leaders. This is no 20-Minute Leaders ordinary episode. Today we're going to be having a panel with some of the most amazing thinkers that sit on boards of companies. We're going to be talking about communication. We're going to be talking about veto rights. We're going to be talking about transparency. Welcome Timor Arbel-Sadras, Liat Aaronson, Y.Benjamin, and Nimrod Vromen. Please take the stage. Welcome, everyone. This is so exciting. This is actually the first time that we're hosting a panel of this sort here on the show, and I'm incredibly honored to have all of you here. It's a really special, event for me to get to know the insights from four incredible thinkers and doers in the ecosystem here. And today we're going to be talking about different sides of venture capital than we often talk about. A lot of the times we talk about how to raise capital and the different struggles of reaching product market fit, but this is not the conversation. This conversation is about how do startups interact with the venture capitalists, with board members. And we have here Y.Benjamin, Liat Aaronson, Nimrod Vromen, and Timor Arbel-Sadras, all with uniquely different perspectives, some from research, some from board members, some from the entrepreneurial field. And so we're going to have a great time getting to know each other and having some fun conversations. And let's just quickly do around getting to know all of you. Liat, who are you?
Who am I? Well, I'm chairman of the Zell entrepreneurship program at Reichman University, something I've been doing for a long time, for the last 7 years and 10 years before that as executive director. And I'm also a co-founder and the COO of a blockchain startup called Horizen Labs.
Incredible. Nimrod.
Well, I've been working with entrepreneurs from the ideation phase through to the exit or wherever they get to, building big companies, historically as a corporate lawyer, and recently as a business consultant through a consulting arm of our firm called Consiglieri.
Amazing. Timo?
Yeah, so I'm the CEO of LeumiTech, the high-tech arm of LeumiBank. Very recent in my current job, and before that, I was for many years a managing partner at Viola Credit, which is a venture lending arm fund of Viola Group. And after working for so many years with CEOs and CFOs in growth revenue stage startups, I thought I knew something about startups. And then I jumped into a startup myself, being a COO of a fintech startup called Eversty. And then I learned how much I didn't know. So I came to LeumiTech both with the experience of being a fund manager and a board member, plus an executive in a startup company.
Beautiful. And Yael, welcome.
Hi, thank you. So I'm the founder of Startup Snapshot. It's a data sharing platform for the startup ecosystem. And we just did our fourth report, which is based on data from 300 founders and board members around kind of the CEO board dynamic.
Well, this is what we're here to talk about. And we have some fascinating topics to uncover from veto power in boards and transparency between startups and the board itself, and the communication of how do we create this transparency and then communicate thoughtfully throughout the journey. Yael, Startup Snapshot, an incredible project looking at the ecosystem from a bird's eye view. I've been following it so closely and enjoying the insights so much. Tell me a little bit about the project and some of the high-level insights that you've uncovered.
Yes, so it's a project I started working on about 2 years ago. And kind of our whole goal is to increase transparency in the ecosystem. So what we're doing is we're collecting a lot of data from founders. We collected to date over, I think, from 1,100 founders. And we share the insights with the entire community so that everyone can kind of benefit from this experience and knowledge that we have in the ecosystem. And the past couple of months, we wanted to really uncover insights on the board, what happens behind the closed doors of the boardroom. And today, it's really interesting. Today this topic is super important with the growing size of the early stage rounds. So before you would have maybe 2 small angel investors on your board, and you can have some kind of a informal ad hoc discussion, meet in a cafe every once in a while, update them. But now these same founders are raising tens of millions of dollars, and they have large international funds on their board. And they're unfortunately, there's new kind of opportunities, but they're also meeting new challenges. So that's kind of what we wanted to research the past couple of months. And we collected data from 300 founders and their investors. And I'll just give a couple of small tidbits that were really interesting here. So the number one thing was around communication. Kind of how do you manage this ongoing strategic communication with board members? And it's really interesting. 61% of CEOs reported they're not fully transparent with their board. So what are they doing? They're sugarcoating difficulties. They're waiting to report certain challenges, maybe trying to find a solution before reporting the actual roadblock or challenge. And it's creating a lot of challenges. So I think 36% of startups reported that they have a challenging board member. It's creating a lot of arguments, pushback, vetoes. Unfortunately, 28% reported that a board member has vetoed a decision. So board members are really, taking larger risk. They're pouring larger funds into earlier stage companies, but they're also asserting their control through vetoes. So that's on the one hand. On the other hand, due to the lack of transparency, startups aren't able to maximize the value from their board members. So board members overestimated the value they provide by around 20%. So without kind of being open, without communicating in a really transparent way, without saying, this is my challenge, this is the help I need from you, unfortunately, startups aren't leveraging this amazing asset that they have at their fingertips.
Amazing. And I can already see Liat, Nimrod, and Timor nodding their heads in agreement as we're touching on the different topics that they're going to be talking about. Nimrod, tell me a little bit about the weapon of mass destruction in one of the weapons of mass destruction, and perhaps in a startup life, or in difficult moments in which a veto may be exposed. What is the veto? And I think in general, Yael, what you were talking about, a lot of these things, I feel as somebody from the ecosystem, we don't talk about it enough at all. And so I'm so excited to dive deep into these conversations with you. Nimrod, tell me a little bit about vetoes.
Okay, well, first of all, I sort of coined the phrase that, the exercising of a veto right is a weapon of mass destruction, or the use of a weapon of mass destruction, which is...
But I said it first.
You said it first, and I slightly regret introducing it as a term, but because it's a little bit more extreme, but it gets, it's like a good clickbait when you say it. But let's start with the academics. First of all, to understand what a veto right is, you sort of need to think about how decisions are made in a company. Decisions are made in a company in 3 layers. First of all, on a daily basis, executives and managers make decisions about their domain, and they don't always consult upwards. And sometimes they consult with a CEO, and that's another type of executive or manager. Within that domain, the individual makes the decision, and there's no real corporate law around that. Then there are another 2 organs that make decisions in a company: the board of directors and the shareholders. The shareholders are the sort of like the highest organ, and they make decisions that are capitalistic in nature and are sort of in line with their own interests. And the board is a bunch of people elected by the shareholders. Sometimes members represent investors, and sometimes members represent management or founders. And that organ has to make decisions in the interests of the company. That's the default. They can't focus on their own personal interests by default. Now, in those 2 organs, the shareholders and the board, the default is that decisions are made by a majority. So if 51% of the shares or 50% plus of the shares approved something, anything, most corporate laws will support that decision will pass by the company, by that organ. Most corporate laws. If a board of, let's say, 5 people had something, on the agenda, and 3 members of that board, because board members normally vote 1 vote per person and not reflective of shareholdings. Again, there are exceptions to this rule, but let's talk about startups and how they behave. Then 3 people in that 5-person board could approve the decision. The veto right is the ability of one or two individuals in the board, obviously the investor-appointed directors, to say, well, despite the fact that you got 3 people out of 5, we're still blocking this thing. Or at shareholder level, it's the ability of a certain group of shareholders, normally the holders of preferred shares, the investors, to say, well, despite the fact that you lobbied the approval for this decision, let's say a financing round, right, of 50% plus of the shareholders, we're still blocking this because we are allowed to block this pursuant to the documents that were signed when we invested in the company. So it creates this dynamic where basically, bottom line, the CEO has a list of decisions that he or she know that they cannot pass without their investor support. Now, let's sort of stray from there for a moment. In startups that work well, all decisions are approved by 100% of the board members. Very rarely have I seen people vote against in startups that work well.
Really?
Right? Yeah, because it becomes a due diligence problem. If I show the next investor that people are voting against different decisions, whether or not there are vetoes, it becomes an issue for the company and in future investment rounds.
Liat, do you agree that this is a form of weakness, that we may have board members who sometimes may be voting against some decisions?
Yeah, no, in my experience in boards, I'm fascinated by everything that Nimrod just said, because I've been on many boards and I've actually never seen any of that dynamic at play at all. So I can't opine on it.
What, you mean that you haven't seen decisions unanimously approved?
No, I haven't seen the veto of the weapon of mass destructive used.
No, of course. We're in total agreement. What I was saying was that, in my experience, normally decisions are approved unanimously. Everybody supports them. There's good communication between the board members and people support them. However, the report shows that 28% of managers have experienced board members that have arrived at a decision and said, no, we're voting against and we're exercising our veto right. And frankly, I was so surprised by that as well, that's why I said, well, that's a weapon of mass destruction. That shows that someone wasn't ready for a discussion and that an investor decided to block them.
And that's what I was going to say, because from my experience, it's not that everyone communicates so well, certainly not on a board meeting level, but what ends up happening is that there's communication before, there's communication during, there's communication from the different levels that you spoke about. So by the time that something comes up, there's some consensus built around it. And so I haven't seen decisions where someone comes and flatly says no in a board decision, but I have definitely seen. I can completely relate to the statistic that talks about a kind of a problematic board member or someone that comes in and either kind of makes the meeting a little bit more aggressive or more contentious. So it's not about the voting; it's more about kind of the management of the meeting itself and maybe a lot of the back end and kind of back channeling that goes around that.
Yeah, I mean, I fully agree. This is where the report, I think, included a very important insight. I've personally witnessed many boards that included challenging board members, but then when management understood that a decision that they were about to pass wasn't going to pass unanimously, they decided not to really bring it for approval so that it didn't, put the company in a situation where it disapproved. And now let's be very practical for a moment, because, this is the topic that I thought I was going to elaborate on. In the board, a decision like that, let's put aside a financing transaction or an exit, which is mostly what founders dream about. Let's say the hiring of an executive, which requires the grant of a certain number of options, and the number of options seems high to the board members represented by the investor. And then there's a challenge around that, or a budget approval. If in 28% of companies, clearly not the companies that we've been involved in, they got to a point where somebody said, no, this is not approved, and sort of sent the CEO back to the executive and to tell them, well, you didn't get your options, too bad, or disapprove the budget. Those situations are extreme. What they show is that either the CEO pushed too hard to pass the item on the agenda, without having prepared all of their board members first for the discussion beforehand, which is a critical, piece in the process. But it also shows that there was an investor who was cavalier enough to say, I don't care what this shows in due diligence. I'm going to still stamp the no on this. This is going to show that I didn't support management.
So Nimrod, I think that raises an interesting question. It's interesting for me to see what you think about it. Whose responsibility is it to prevent vetoes? Is it more on the side of the entrepreneur that has to communicate ahead of time, has to decide ahead of time what they're going to bring up for approval, or on the side of the investor that obviously wants future funding rounds to go well?
Sorry, go ahead, Timor.
I think at the end of the day, this is the job of the CEO.
100%.
To work with the board members, or even to manage the board in a way that doesn't bring issues to the point where decisions need to be taken. So that would require, one-on-ones. That would require non-formal board discussions in order to, to get into compromises or agreements, or to work. Like in Nimrod's example about budget, so to work together non-formally on the budget until we get to a solution that everybody's in agreement with. I think that getting into a situation of veto or board members that object to decisions is really bad to the company.
Well, we're gonna leave the conversation here, and I'm sorry, Nimrod, but we have to move on to the other topics. But we have already another panel scheduled, and we're gonna have to revisit this conversation. And I think this is a perfect segue, Timor, to talking about this idea of managing the board and being able to communicate well. And the discussion of communication has to start with this idea of transparency, and this idea of how do we actually instead of the foundation of managing the board is first to be able to get the board to understand what's happening and to be able to be open and authentic about what's going on in the status. Liat, what has been your experience and your observations with the way that entrepreneurs make the shift from wooing the investor to now, working with them as a partner?
Yeah, it's a great segue actually to the other topic as well, because it's, I agree with Timor that it's 100% the CEO's job to manage this situation. What I think happens after a founding round is that there's a psychology where the entrepreneur that was so busy in a sales mode, trying to put the best face forward, the lipstick on the gorilla, and making it look really, really, really pretty, making sure no one's looking under the hood, and then all of a sudden, once the investment's made, and I've literally seen an investor tell an entrepreneur, dude, I'm already invested. I'm in this now. So go ahead and, open the hood. It's okay. I'm in. And I think what happens is that shift. It's an amazing opportunity. Not everyone's able to do it, but the amazing opportunity is for an entrepreneur to take from sales mode to now I have this asset, this kind of opportunity for an asset to be able to use the wisdom, the experience, the connections, everything that the investor is bringing in order to actually share the real problems and, voice the real concerns. And kind of going back to the other discussion, I've seen boards that are managed by a CEO, and I've seen boards that are managed by the investors, and clearly being managed by the CEO is the right way to go. And a CEO that really appreciates that and is able to be transparent, do the communications with each investor ahead of the board meeting and manage the board meeting through that transparency and actually being able to use that incredible resource.
I love that. Nimrod, Timor, thoughts on this idea of being able to make that shift from personal experiences or observations?
I think that it's important to remember, like for CEOs and CFOs and entrepreneurs, to try and imagine the situation from the viewpoint of the investor, because it's important to realize that VC is not a scalable business, right? Because each partner has a certain amount of companies that they can be involved with. And so imagine a board member that sits like on boards of 8 companies. And unlike the executives in the company and entrepreneurs that, they live day by day the reality of the company and the challenges and the wins and the successes and the losses, the board member pops in once every while. It can be once a week, once a month, once a quarter, depends on the company. And they need to help the company to make the right decision, or even maybe only to ask the right questions. And for them to be able to do that and to really help the company with their experience and abilities, they need to be able to quickly understand the situation and the challenges that the company faces. And one of the ways, we talked about transparency, so this is one way of doing that. And the other way is to use the language that the board member can easily understand. So and there are some standards. We see, the standard financial terms or indicators. Like for example, it's very popular for SaaS companies, right? There are the standards metrics that people are looking at. If you're using the standard terms and the standard KPIs, it's much easier for a board member to grasp the reality, the challenges, the opportunities very, very quickly, and to be able to help. So I think for a young managers, it's very important to take the time and learn the language that the board members are used to work with. Even the simplest things. Do you show your plan on a monthly basis or on a quarterly basis or on a yearly basis? We are so used to see stuff on a quarterly basis that sometimes when they show it to you on a monthly basis, it takes you a while to grasp the trends of what this every number means. I think. Sorry.
Yeah, no, and I think that's a great point. I think it's not only what kind of metrics make sense, but it's also what kind of language. So if it's a more technical, an investor with a more technological background that's more interested in the product and the technology, then you kind of take that conversation. If it's someone who's really only interested in the Excel, then you don't talk about the challenges of your development, of your developers and the product development piece. You go straight to the numbers. So I think investors are also, they want to bring what they have to the table, but they definitely don't want to be put out of their comfort zone and try to opine on things that they don't know what to opine on, and actually not very useful for the company either.
Definitely. I think, Liat, based on what you said also, you have to understand what are the strengths of each of your investors and kind of ask them for help in that specific domain of where they can help. You have to kind of manage the help that they can give you. I think one of the interesting stats that we found is that 81% of investors said they really want to get specific tasks from their portfolio companies. Basically, make this in this intro, to this executive. But the majority, 70% of founders, said they don't feel comfortable asking for help in that way. So it's really a missed opportunity. You have to understand what are the strengths of your board and who can help you with different types of things. And really, after every meeting, after every email, kind of reach out and ask for that help.
Nimrod, I'm seeing your eyes popping out of your head.
Yeah, well, I want to, first of all, I've been waiting. I fully agree. Sort of like to view the world in terms of what's like the default situation or the ideal situation, and what reality warrants. And I hope Timor and Liat don't kill me for this, but I want to take a different approach. Up until 2 years ago, I would have agreed wholeheartedly with everything that was said up until now. I think the company's life cycle was 7 to 9 years, and people were expected to gradually increase in valuation and utilize amounts of money in a more sort of gradual manner. And grow into the CEO position. And then you could totally be disappointed if they missed on using the board members or on terminology, etc. Investors, who get paid a lot of money for their jobs and invest in hundreds of companies are dumping over the last 2 years tens of millions of dollars on CEOs who they know and I know and we know have never managed budgets of tens of millions of dollars. All they came with was a hot idea in cyber, a general understanding of the market, and it's a long time ago that we started investing in companies that are already second tier or third tier. The best companies go to the tier one investors. And that's where you get also the sort of the roundest founders who are repeat founders and know how to avoid situations. I want to see any tier two fund downwards who know they are tier two funds allocating additional investment amounts at higher valuations for founder growth, for mentorship, for actual business courses. The expectation that founders come into the position of a CEO like the Leonardo da Vinci of managers is ideal, and it's certainly the case when you're not sort of pushing the founder to take. I've seen companies take this year alone a term sheet for an A round and be served and encouraged to close a deal for a growth round 4 months later. We've seen that many times. Those CEOs, if they don't get like monetary support, I'm not only talking about the investor, because Timor is right, the investor has 8 board members. I'm talking about a value creation fund outside of the VC, additional cash to invest in this growth. Otherwise, it's not going to come from these people. They're young individuals. I manage Consiglieri, it's a startup. I don't have an idea always. I can talk about my clients or about certain aspects of the business, but if they don't, literally pay to teach me, it's not going to happen. And then the dynamic in the board sort of hinges on the personal relationships. And because I know Timor and I know Liat, and I know their experience and their access to companies, I have no doubt that they've had really good correspondences with companies they've invested in. But there's such a long tail of companies that take money from a long tail of investors, from a longer tail of investors, where unfortunately that's not the dynamic. And in those companies, in that long tail, I'm putting it solely on the investors. They gave the money, they're cutting the management fee, they need to support the CEOs because they genuinely came up with an idea and they're hoping to make it work. And for the company to succeed, all the stars need to align. There's a difference between the cream of the crop and people that are growing into it. That's all I'm saying.
But at the end of the day, the CEO is responsible, with all due respect to board members, the CEO is responsible for the success of the company. And
of course,
I agree with you that, CEOs, especially these days where you see young CEOs and young companies facing mature funds and very large amounts of investments. This is at the end of the day business of trust, and the CEOs that wants to succeed needs to find a way to create this trust. And yes, ask for the mentorship or demand the mentorship. But at the end of the day, I think this is the CEO's job. Well, the investors, they need to help. Okay. It's their best interest, right? But this is the CEO's responsibility to demand this mentorship, to find the way to grow very quickly as the company grows.
I'm not arguing with that, but 70% of the CEOs don't approach them, according to this thing.
Yeah.
So some people are approachable. Maybe the people here, I'm approachable, you're approachable. Those who aren't approachable, they spin it. They need to call it, and they need to be approachable. There are ways to do that.
I think I love that you think that all of the boards that I've been on are like happy. Clearly, that's not in the reality. Plus, through the Zell program, I've been involved through some of these younger founders, through a lot of other board dynamics as well. And I still completely agree with Timor. At the end of the day, it's the CEO backed by his co-founders that support him that has to manage the relationship. It's not only about, they can be young and inexperienced, and still it's a psychology. It's an exercise in psychology more than it is about knowing what the right decisions are. Now, I think that leap, that jump to being able to use the board members is important, but really a company that's going to be run by its board is, to me, inherently in a challenging situation, like a really, truly challenging situation. And I've seen that as well. I don't think, I think ultimately the CEO needs to manage to make use of the investors. And frankly, investors are investors. They, I think they need to know how to raise the money, choose good deals, and help them get to exit. I think they overthink themselves if they think that they're going to be so instrumental in actually running the company. If they need to run the company, I think, Houston, we have a problem.
We're continuing exactly where we left off. Timor, finish off our conversation about board members and startups, but this is just the beginning because I think we're going to have many more of these conversations moving forward. Timor, how can startups better standardize communication between the startup founders and the executive team with board members that sometimes are sitting on 8 different boards and don't have time to constantly be thinking about the startup?
So we talked about building trust, and since it's a big issue at the beginning, especially these days when we see young startups raise a lot of money. So they don't start the company with angels, but rather with very professional investors. And they need to find a way to communicate and build this trust in a way that is not too time demanding from the CEO. The CEO at the end of the day need to be laser focused on growing the business, right? And we see ridiculous demands coming from investors that didn't build trust. Like for weekly calls with the CEOs. Now imagine the CEO needs to do weekly calls one-on-one with 5 different board members every week or every month. This is ridiculous, and this is hurtful for the company. So creating some kind of a format for updating them, aligning expectations on what important issues need to be reported, and making a scheme, a format of, for example, a report with the important factors would be very beneficial in this stage. And I would strongly recommend those young CEOs to get help from experienced financial managers, either within the company or as a consultant or as a mentor, to help building it correctly. And then maintaining it gets much easier once you have it in place.
I love it. And
I'll just throw out a shout out here. So at Horizen Labs, we are super fortunate to be to have DCG Digital Currency Group as an investor, and Barry Silbert is the lead investor there. And he and DCG has a format for us to fill in on a it's actually a quarterly basis, and it's super clear and concise and asks for the exact information that they want to get and information that we know how to compile for them, and it makes for really, really easy communication. So I completely agree, Timor. From the founder side, as a founder, I can say it's amazing.
I love it. And I really want to thank all of you here for joining. This was so much fun. Yael, thank you so much for putting this together. And thank you, Liat, Nimrod, and Timor for joining us and for taking part in this incredible conversation. This is a start of many more. And I learned an incredible amount. And I can't wait to share this with all my friends and with everybody in the ecosystem. It's going to be fantastic. And stay safe and stay healthy, everyone. Thank you.
You too.
Cheers. Thank you very much. Thanks, Michael. Thanks, Yael. Thanks, Liat and Timor.